TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
So, if you looked at the S&P 500 on July 14th of 2026, you'd probably think the market was perfectly blissfully calm.
Oh, absolutely. I mean, it barely moved at all.
Right. But under the hood, the literal plumbing of the market was just quietly collapsing.
Yeah, it's honestly the ultimate financial trap. Because today, for this deep dive, we're looking at a stack of daily quantitative market notes from a major analytics firm.
And these cover both the morning and afternoon sessions.
Exactly, tracking the entire week of July 13th to the 17th. And I mean, reading them in order is it's like watching a horror movie.
Oh, for sure. Where the audience sees the monster sneaking up, but the characters are just enjoying a picnic.
Right. And to cap it all off, we have this really comprehensive strategic summary that ties the whole week together. It literally frames this exact week as a breaking point for the tech market.
Which is wild. So our mission today is to take you, the listener, inside that data. We want to decode those hidden structural signals that basically gave away the Friday market crash days before it actually happened.
Because, if you understand how to read the mechanics, you don't have to rely on just guessing.
Yeah, or just staring at surface-level price action.
Exactly. I mean, price is really just the advertising, right? The underlying mechanics are the actual reality.
That is a great way to put it. So, let's unpack this. Going into Monday and Tuesday of that week, the macro data was actually pretty soft.
Yeah, we had cool inflation prints like CPI and PPI.
Right, and the broader market index, the SPX, it reacted with this microscopic trading range. On Monday, it traded within a 78 basis point range.
It's barely a blip.
And then Tuesday was even tighter, 58 basis points. It was just stubbornly pinned right at the 7,500 level.
Which, the natural assumption there is just that the market is efficiently digesting the soft macro data.
But the notes tell a totally different story.
Oh, completely.
Yeah.
They attribute that unnatural calm to a massive wall of what they call positive gamma from option dealers.
Okay, so let's actually break down what that means mechanically, because it sounds like jargon.
It is, but it's the linchpin for the entire week. So in the options market, you have market makers, these institutional dealers, and they take the other side of your trades just to provide liquidity.
Right, but they don't want to actually take on directional risk.
Exactly. They aren't betting on the market going up or down. They just want to collect the spread. So to stay neutral, they have to constantly hedge their books by buying and selling the underlying stocks.
Delta hedging.
Yes, delta hedging.
So when the notes say the street was in a state of positive gamma, how does that actually dictate their behavior?
Well, when dealers are net long gamma, the math of their hedges forces them into this really specific kind of counterintuitive behavior.
Okay.
If the market dips, their exposure shifts in a way that mechanically forces them to buy the index to get back to neutral. And if the market rallies, the math forces them to sell.
Oh, wow. So they act almost like a high-end suspension system on an off-road vehicle.
That's a perfect analogy.
They're quite literally eating the bumps. Every time the market hits a pothole, dealer buying pushes it right back up.
Right. And every time it catches air, dealer selling pushes it back down.
Yeah.
It creates this mean reverting environment.
So volatility is basically artificially compressed.
Exactly.
Yeah.
Because there's a built-in buyer for every dip and a built-in seller for every rip.
And, this suspension system was being severely tested that week. I mean, we weren't in a slow news week.
Not at all.
The notes specifically track these major geopolitical shocks hitting the tape. Tensions were escalating with Iran, and there were comments from former President Trump telling Congress that, quote, war is back on.
Yeah, that caused a huge spike.
And just to pause here for you listening, we are impartially reporting the contents of these financial notes just to explain the context of the oil spike. We're obviously not endorsing any political viewpoints here. We're just tracking how these ONs hit the market.
Absolutely.
Yeah.
Because the objective data we're looking at shows those headlines instantly drove crude oil up to $78 a barrel.
Right. Which are serious systemic external shocks. That should have rattled equities.
But they didn't. I mean, at least not on the surface. That positive gamma was just so thick around that 7,500 level that the dealers absorbed the geopolitical oil shock without the index breaking a sweat.
Which naturally leads to a pretty dangerous assumption, right? If I'm an everyday investor and I know that these institutional dealers are mathematically forced to act as a shock absorber.
Right, they have to buy every dip.
Yeah, then why shouldn't I just piggyback on that? Why not just buy every dip myself knowing the dealers will catch me?
Because you are relying on a safety net. that has a hard expiration date.
Ah.
That positive gamma isn't like a permanent feature of the market. It's a totally temporary, expiring condition tied to millions of individual options contracts.
And those contracts have a shelf life.
Exactly. They expire.
Yeah.
And when they do, the suspension system doesn't just slowly degrade, it snaps off the vehicle completely.
Okay, so the surface is flat because of dealer hedging. But if the dealers are acting as this massive shock absorber at the index level, eating all these geopolitical shocks and macro shifts, all that kinetic energy doesn't just vanish, does it?
No, it has to go somewhere.
Right, so where does it go?
It goes right into the individual stocks. And honestly, this is where the daily notes get truly fascinating. They track this metric called the 1-month implied correlation, or key R1M.
Yeah, the notes emphasize this heavily. They point out the key R1M was sitting at these extreme 2-year lows, like closing Monday around 4 and Tuesday at 4.6.
Which is well below their critical threshold of 8.
So mechanically, for the listener, what is a sub-8 correlation actually doing to the market?
It means the individual stocks inside the S&P 500 are completely decoupled.
Okay.
Like, in a normal environment, stocks generally trend together, right?
Yeah.
A rising tide lifts all boats. But at a correlation of 4, you have absolute dispersion.
So massive, violent moves are happening in individual sectors.
Exactly. But because they are moving in opposite directions, they cancel each other out at the index level.
It's like the ultimate tug-of-war. Like a really bizarre game where half the team is sprinting forward and the other half is running backward.
Yeah, and the S&P 500 barely moves at all.
Exactly. So let's look at the massive energy on the winning side first. You had Goldman Sachs soaring 9% in a single day.
Hitting an all-time high of 1,140.
Right, off the back of monster trading desk revenue.
Yeah.
And then you had Apple hitting 328, also an all-time high.
And the notes mentioned Apple had a staggering $5 billion of gamma notional behind it.
Wait, $5 billion?
Yeah. And that $5 billion in gamma notional is essentially like a localized gravity well.
What does that mean in practice?
It means the options activity specifically concentrated on Apple was so intense that it was uniquely forcing dealers to aggressively buy Apple stock just to hedge their upside exposure.
So it fuels this crazy feedback loop that just
Yeah.
drives the price even higher.
Exactly.
Okay, so Goldman and Apple are sprinting forward. But to keep the index flat at 7,500, something massive has to be sprinting backward just as fast.
Right. And that would be foundational tech and semiconductors. The rot underneath the surface was severe.
Severe is putting it lightly. I mean, while Apple was surging, IBM dropped 25% in a single day.
Following a sales miss.
Yeah, and the quantitative notes highlight this was IBM's worst single-day drop since Black Monday in 1987.
Which is just, I mean, that is not a normal correction.
No, that is historic destruction in a legacy blue-chip tech stock.
And the contagion spread directly into the semiconductor space, too, specifically the memory sector. Like, we saw SK Hynix drop 9%.
Yeah, the semiconductor ETF, the SMH, was basically in freefall.
And the underlying catalyst for this rotation is really interesting.
Oh, the AI thing.
Yeah. The notes tie this semiconductor bloodbath to the release of a new AI model called KOSPI 3.
And they describe this model as having, quote, fable-like capabilities.
Right, which is a perfect example of how structural market mechanics react to, fundamental technological shifts.
Because if KOSPI 3 is demonstrating next-generation generative logic.
Right, logic that requires vastly more efficient processing rather than just brute forcing massive amounts of traditional memory hardware.
The market immediately starts repricing the entire legacy supply chain.
Exactly. The hardware basically becomes obsolete overnight in the eyes of the market.
And the velocity of this repricing was just terrifying. Like, the notes highlight specific options flows to show just how fast the bottom was falling out.
Are they SMH puts?
Yeah, in just 3 hours, someone bought 10,000 contracts of SMH 600 puts that surged from $22 to $35.
And even more extreme, the 570 strike puts exploded from $4 to $10.
In 3 hours. A 150% gain on an out-of-the-money put.
Yeah, and when options reprice that violently, it tells you that the dealer hedging we talked about earlier is completely breaking down on the individual stock level.
And the dealers who sold those puts are scrambling.
Oh, absolutely. They have to short the underlying semiconductor stocks to hedge their exploding risk.
Which just adds more fuel to the downside fire.
Exactly. The momentum feeds on itself.
So we have this incredible dynamic. The index is a placid lake, but underneath, Goldman is on fire, IBM is having a 1987-style crash, and semis are being structurally repriced by new AI.
Right.
And this disconnect between the calm surface and the chaotic reality underneath creates a massive behavioral trap for retail investors.
Huge trap.
Because if you aren't looking at the plumbing, you just see a dip to buy. Which brings us to arguably the most dangerous ticker in the data this week.
Oh, SpaceX. Ticker symbol SPCX.
Yeah.
This case study perfectly illustrates why fundamental hype will just always lose to structural market mechanics.
So the notes flag that SpaceX was down 14% since its inclusion in the Nasdaq 100 index. Now, I want to challenge this because it seems totally counterintuitive. Well, when a massive company gets added to a major index like the Nasdaq 100, passive funds and ETFs are literally mandated by their charters to buy the stock, right?
True.
Shouldn't that wall of forced buying push the price up, or at least counteract the 14% drop? For the listener who sees a hyped company on a 14% discount, shouldn't they think it's a bargain?
You would think so, and that is exactly the assumption that traps so many buyers. But the mechanics invert here because of two massive structural forces overriding that passive buying.
Okay, what's the first one?
First, the timing. The notes point out we are 30 days post-IPO. That triggers the expiration of the lockup period for early insiders.
Oh, wow. So all the venture capital, the early employees, the pre-IPO investors who were legally barred from selling their shares on day one.
They are suddenly allowed to hit the bid.
So they're cashing out.
Exactly. You have a massive flood of new supply hitting the market that just completely overwhelms the passive index buying.
Okay, that makes sense. But what's the second factor?
The second factor is even more dangerous. The quantitative models mapped out heavy negative gamma sitting right at the $125 level.
And that aligned perfectly with this lockup expiration in early August.
Right.
Okay, so if positive gamma is the suspension system eating the bumps, what does negative gamma do to the vehicle?
It reverses the steering.
Yikes.
Yeah. When dealers are in negative gamma, the math of delta hedging flips. Instead of buying when the stock drops, dealers are now forced to sell into the weakness.
Wait, so if the stock goes down, their models force them to short the stock to stay neutral?
Exactly. It is a pure doom loop. You have insiders dumping millions of shares because the lockup ended, which pushes the price down.
And the price dropping forces the option dealers to short the stock, which pushes the price down further.
Which forces them to short even more.
So for you listening, if you see SpaceX, one of the most culturally significant companies on the planet, trading at a discount and think, this is a gift, I'm buying this dip, the actual quantitative data is screaming the opposite.
The plumbing is primed for a violent liquidation.
Right. This is why you cannot trade strictly on narrative. Like, the narrative says SpaceX is revolutionizing aerospace.
But the plumbing says the stock is about to be systematically dismantled by lockup liquidations and negative gamma hedging. The sources explicitly warn against catching that falling knife.
Absolutely. So all week long, we have this incredible kinetic energy building. You have the calm surface held up by the positive gamma shock absorbers at 7,500.
Yep.
While the underlying stocks are experiencing historical divergence and dispersion, something has to give.
And the catalyst arrived on Friday, July 17th.
Friday, OPEX, options expiration day.
Yeah, the expiration date for all those millions of contracts holding the index together.
You know, earlier I compared the positive gamma to a suspension system. Friday OPEX is the moment you hit a massive pothole, and right at the point of impact, the entire suspension system just vanishes.
The chassis takes the full, unmitigated force of the crash.
It's like the moment the clock strikes midnight for Cinderella. The magic spell of positive gamma wears off, the carriage turns back into a pumpkin, and the market has to face reality.
And the transition from calm to chaos was immediate. The quantitative notes projected early in the week that the vast majority of that positive gamma would just roll off the board on Friday.
Right.
They established a critical line in the sand, a risk pivot on the S&P 500 at 7,480.
The logic being, as long as the index stayed above 7,480, dealers still had enough positive gamma to keep the market pinned. But if it breached that line,
the dealers flip from positive gamma to negative gamma, the shock absorbers become accelerants.
And that is exactly what happened.
Without the options contracts forcing dealers to buy the dip, the index had absolutely no defense against the massive tech sell-off that had been brewing all week.
So the SPX broke straight through the pivot and closed at 7,458.
Down it went.
The strategic summary we looked at, which was actually written in Czech, interestingly enough, uses a really specific phrase for this moment. It calls it the bodslamu.
The breaking point.
Right. It literally describes this as the end of the options illusion.
It's a very apt phrase. I mean, the entire behavioral regime of the market flipped in a single afternoon. From Monday to Thursday, the regime was mean reverting.
So if you bought the dip, you made money.
But by Friday afternoon, it flipped to trending.
Meaning the sell-offs began to accelerate and cascade without any dealer cushioning.
Exactly. Just look at the volatility metrics. The VIX, which had been artificially crushed all week, violently woke up.
It spiked over 12% in a single session to close at 18.76.
The hidden fear was suddenly very, very visible on the surface.
So once that BOD Zlomo hit, once the index broke below 7,480 and the suspension system was completely gone, the playbook in the strategic summary shifts drastically.
Right. It tells institutional clients to immediately stop buying dips.
But it doesn't just say go to cash. It gets highly tactical about how to play the downside, specifically recommending structures like put flies on the major indices and put ratios on the tanking tech stocks.
Yeah, that's an important shift.
Let's translate that for everyone. If the market is crashing, why use complex structures like put flies? Like, why not just buy regular plain vanilla puts?
Because of what we just discussed with the VIX. When the VIX jumps to almost 19, implied volatility expands.
Okay.
That means the premium, the actual cost of buying a standard put auction, becomes incredibly expensive. If you just buy a naked put, you are paying a massive premium for that volatility.
And if the market just chalks around sideways, you bleed out from the cost of the option.
Exactly.
So how does a put fly solve that?
Well, a put butterfly, or put fly, involves buying a put at a certain strike, selling 2 puts further down, and buying 1 more even further down.
Sounds complicated.
It sounds, but mechanically, you are just financing the cost of your downside protection by selling options to someone else. It strictly caps your maximum profit, sure, but it drastically reduces the upfront capital you have to risk.
It's a highly defensive way to position for a crash without overpaying for the insurance. And the put ratios they recommend for the semiconductor stocks follow a similar logic, right?
Yep. Okay.
You buy 1 put to capture the drop, but you sell 2 or 3 further out of the money puts to finance the trade. Taking advantage of the fact that the panic is making those deep out-of-the-money puts wildly expensive.
That's it, exactly. The playbook shifts from passive complacency to active finance defense. You're basically using the market's own panic and high volatility pricing to fund your downside protection.
It is a masterclass in adapting to structural realities, and that ultimately is the big takeaway for you listening today.
Yeah, you don't have to be a Wall Street market maker running complex gamma hedging models to benefit from this kind of analysis.
Right. The real lesson here is about knowing what is actually holding the market up, like OPEX dates, correlation metrics, dealer positioning. These aren't just arcane finance terms.
No, they are the structural mechanics that dictate whether your investments are safe or if you are, stepping onto thin ice just as the spring currents are raging underneath.
Because understanding the difference between surface price and underlying plumbing is what separates the tourists from the professionals.
And when the mechanics shift from positive gamma to negative gamma, the rules of gravity literally change.
And if you aren't paying attention, you end up buying the dip right as the floor gives out.
Which brings up a pretty alarming unresolved tension that these sources leave us with. Yeah. We know the SPX has lost its safety net, right?
Yeah.
The breaking point was crossed on Friday.
Yeah.
But next week, the Mag 7 Titans companies like Alphabet and Tesla are scheduled to report their earnings.
Oh, man. The heaviest weights in the entire index.
Right. And the options market is already pricing in massive 6% directional moves for these trillion-dollar companies on their earnings days.
Wow.
But remember the setup. The broader index has zero defense left. The dealers aren't there to absorb the volatility anymore.
Wait, really? So the correlation was already at 2-year lows, and the only thing holding the flag in the middle of the tug-of-war was Apple and those few mega caps.
Precisely. So the question you have to ask yourself is this. If the broader market has no shock absorbers left, and the only stocks that were holding the index up are now stepping directly into the earnings crosshairs with 6% volatility priced in,
What happens to the entire financial system if the final massive pillars holding up the tent decide to buckle?
something to think about.
That is a chilling thought to leave on. The suspension system is gone, the safety net is pulled, and the heaviest weights are about to jump. Definitely something for you to keep an eye on next week.
Thanks for diving into the plumbing with us, and we'll see you next time.